Hello, everyone. My name is Peter, and I welcome you to PwC Tax Bite podcast series. In this episode of the podcast, I'm very happy that I can invite a number of colleagues who have been following the Belgian government negotiations in the past weeks. And together with Bart van den Busse, Willem van Dromme, and Veronique de Brabanter, I will explore with you the measures that have been agreed recently at the level of the Belgian government. First of all, let me introduce the members here in my virtual recording studio. First of all, Bart van den Busse. Bart is next to an expert in reward, also following very closely with me the various reforms and the agreement that has been reached. So together with Bart, we'll explore the various measures that have been taken from a personal tax reward perspective. Next to that, we have Willem van Dromme. Willem is an expert in indirect tax with a focus on systems and processes, and that also covers e-invoicing. So let's explore with him the indirect tax measures that have been taken. And last but not least, I have Veronique de Brabanter. Veronique is part of PwC Legal, and she is specialized in tax procedures and TCDR. Now, let's kick it off. Bart, maybe I have a first question for you. If we look at the agreement that has been reached at the government level, overall, what's your perception to it?
Thank you, Peter, for having me you in this studio. Overall, I would say very glad that there is an agreement and there is also a willingness to tackle some challenges we face as a country. I think the announced reforms aim to balance the budget through one hand structural changes and contribution, of course, from various stakeholders. And of course, if you need to contribute, that hurts, of course. But the most important thing is that it's also linked to increased competitiveness of our country and also contains some measures to attract, for instance, international talent and also, of course, some impact in terms of investment climate in Belgium. So very excited to discuss with you and the other speakers this evening more details about these announced reforms.
Yeah, I suggest we immediately dive into it. And an important part of the measures that have been agreed relate to VAT. So, Willem, I'm turning to you. So the agreement has these VAT-related points. Can you elaborate a little bit for the audience on these points?
Yeah, thank you, Peter, and hello, everyone. There are indeed a number of VAT-related measures in the government agreement that were worth the wait. And I think the most impactful one will be the introduction of a near real-time reporting mechanism in 2028. This measure will actually complement the mandatory e-invoicing obligation that becomes effective in 11 months' time, so being on the 1st of January 2026. And according to the agreement, it will be cash registers, payment systems, and invoicing systems that will have to be integrated with the tax administration, allowing for the automatic transmission of VAT data to the authorities. And the objective of this measure is actually to reduce the potential for VAT fraud by optimizing data mining and improving the efficiency of VAT audits. Because ultimately, the more the authorities know in real time and at a transactional level, the more insights they have. And as a countermeasure to reduce the administrative VAT burden for businesses, the yearly client listing will likely be removed. Another important measure is that the reduced VAT rate of 6% for so-called demolition and reconstruction projects by real estate developers will be extended with a slight change to the square meters allowed. These will drop from the current 200 square meters allowed to 175 square meters allowed in the future. And still in the construction sector, there will be clearer definitions introduced around what is now a new build project and what is a renovation project for VAT purposes. Further, there are also some climate-related changes with, for example, on the one hand, the VAT rate on heat pumps being reduced to 6% instead of the current 21% during the next 5 years. And on the other hand, the VAT rate on the installation of fossil fuel boilers to be increased from the current 6% to 21% in the context of renovation, and equally the VAT rate on coal being increased from the current 12% to 21%, the higher rate, the standard rate. And perhaps to wrap up with another few obligations that were introduced in the agreement. One, the expansion of registered cash systems, so the so-called Wette Kassa, across the whole hospitality sector and other fraud-sensitive sectors. Two, the conditions for donating certain goods with no VAT impacts will be softened. Three, a circular letter regarding the input VAT deduction related to company bikes for mixed use will be issued. And fourth, the penalty regime will be revised to take into account mitigating factors such as the taxpayer acting in good faith and there being no harm to the Belgian treasury. So yeah, a good number of measures, the one more far going than the other one, but I think some steps in the right direction and so some items to follow up on. And with that, I'll maybe hand it back to you, Peter.
Yeah, thank you very much, Willem, for elaborating on that. This reform, I think, is also, and moving back to you, Bart, it's also a quite historic reform, I think, with the introduction in Belgium of a capital gain tax, or should we call it solidarity charge, Bart?
Indeed, what's in the name, Peter, but it's certainly one of the measures that was, of course, heavily debated, very also in the public debate. And of course, it's a very sensitive one. If you introduce a new tax, it's very difficult to get rid of it. Taxes tend more to go up than go down in I would say, the past few years. And if you compare it, for instance, with the special social security contribution, which is also a measure that it still is not abolished or refuses to die, you see the sensitivity of introducing that as a crisis contribution, and it's difficult to get rid of. On the other hand, we need to say that entirely saying that there was no capital gain tax in Belgium is perhaps also incorrect. We already had a tax in terms of miscellaneous income. If you would have did operations outside the normal management of one's private estate, there was already a taxation in certain circumstances of capital gains. And this also still exists. So it will also be very interesting to see how new measures like this new solidarity contribution will be implemented and enacted in the near future. But it's also important. We have now a government agreement, but it's of course not yet draft bills. It still needs to be translated. If I then zoom in more on what is that type of new solidarity contribution that aims to tax capital gains, well, basically there will be a more general tax rate that's set at 10%. Linked with an exemption up to 10,000 euros a year. And the capital gains would relate to capital gains on financial assets and also including investment in cryptocurrencies. Also important, I think, for a lot of investors is that there is no aim to apply this tax retroactively. So that means that there would be an exemption of historical capital gains from the entry into force of the new tax as such. So there also, I think, everything in relation to valuation, proving what was the value before the introduction of the new tax will be a very important one. On the other hand, of course, if you introduce a new tax, there will also be foreseen the deductibility if you have a capital loss from the income in the same category in the same year, but without the possibility to do a carry forward. That's, I would say, the general rule. And then we have seen in the negotiations end of last week that at the end, in terms of negotiations, some a special, I would say, sub-regime has been foreseen, and that specifically aims if an investor has what they call a substantial participation. That means that if you own more than 20% of the shares as such, then you would have not immediately a taxation at the 10% rate. The first million of capital gains would be exempted. And then gradually the taxation goes up from 1.25% up to 10% if you have a capital gain above 10 million. I think also in this respect, again, you have basic principles agreed in the government agreement. I think still a lot of discussions will go on in this respect. How do you need to interpret it? What typically you also need to do if you are a startup and you get diluted below 20%. There are also already some concerns, but again, let's see once draft bills are created, how far it goes. That's of course one, I would say, a very important one. But besides that, I think also more from a reward, if you look at from an employer's perspective, some measures are being announced that could impact how employees are paid. So there will be announcements or change the legal framework in terms of flexible remuneration, so cafeteria plans. They will also focus on, let us say, simplifying, harmonizing existence of collective bonus schemes. So we know all the collective labor law agreement 90, as well as the profit sharing scheme. So that's, I think, an interesting one. And I would say as well, in terms of meal vouchers, if I would call it that, I think the meal vouchers are announced to eat the other vouchers, Peter. So to the extent that the value of the meal vouchers will be increased, the scope will be extended, but all other vouchers that we know, like eco vouchers, culture vouchers, etc., would be gradually abolished. And so that means these type of vouchers are often used as a type of recognition by employers. So they're also, I think, they need to rethink how they will recognize or show recognition to employees, which of course not always needs to be from a financial perspective. Besides that, and that brings us a bit too far, of course, a lot of changes also with respect to mobility budgets that will all be extended for everybody, but also the intention to strengthen the second pillar occupational pension scheme. So I think a lot on the plate, a lot to follow up on, but that's of course more related to reward personal income tax, Peter. If I revert back the question to you, I think there are also some measures that would impact corporate tax.
Yes, yeah, indeed, Bart. The government agreement also includes a number of important changes, I would say, from a corporate tax perspective. But first of all, the government agreements also bring stability. So the fundamental tax rate in Belgium is not changing. The existing tax regimes in Belgium, well known, like innovation income deduction and others, are not changing. So the agreement also brings stability, but also some changes. And for instance, let's take the most important ones. The participation exemption in Belgium will be changed. So the participation exemption applies if you receive dividends or capital gains, of course. And at this moment in time, this is a deduction. So the government will now simplify this and make it more robust by making a genuine exemption. And that will help in various cases where there were conflicts with European law, for instance, in relation to our group contribution. So that's an important one. However, also the conditions of the participation exemption will change. As in the past, if you have 10% of the participation, you will qualify for participation exemption. If next to that you don't have 10%, but you want to rely on the participation exemption based on an investment value of 2.5 million, which also entitles you to an exemption, that threshold will go up. It will become 4 million and an additional requirement. And at least that is the case if you have dividends or capital gains between large companies in Belgium. Next to that, we will make our group contribution system more flexible. At this moment in time, the tax consolidation, the group contribution system is quite restricted. It only applies for direct participations. And if you already had a connection for more than 5 years. That will now change, allowing also group contributions for indirect participations. That's one thing. And secondly, the 5-year period will become much more flexible, allowing companies to immediately benefit from the group contribution from year one. A third element I want to touch on is the investment deduction. So an incentive which is available for certain investments. That regime will be extended. So there will be a carry forward. If you don't have enough profits in year one, you can carry forward without limitations to future years. And in addition, the formalities will be much more simplified and easy to comply with. So extending, improving the investment deduction regime. And on top of that, there would be even a fast depreciation in the first year of an investment, up to 40% for large companies. So again, they're very much stimulating investments by Belgian companies. A fourth element I want to touch on in the corporate tax sphere is the exit tax that would be introduced. So at this moment in time, if a company migrates out of Belgium with legal continuity, the legal personality continues to exist. Now, that will change from a tax perspective. As soon as you migrate a company out of Belgium, that will be considered as a deemed liquidation with potentially applicable withholding tax due on that deemed liquidation. So this, Bart, were just 4 elements I wanted to touch on. There's much more in the agreement, but that was what I wanted to share on a high-level basis. Now, maybe if we go on, there is also a very important part, and Veronique, I want to invite you now to the microphone, because there is also a very important part relating to procedural changes in the tax rules, and that's of course your area of expertise. So Veronique, can you elaborate a little bit on that?
Yes, of course, Peter, and thank you for giving me the floor. Indeed, the new government agreement introduces some significant changes to the tax procedure with a strong emphasis on legal certainty. Of course, we don't have time to elaborate too much, but I give you some key highlights, which is, first of all, a taxpayer charter will enhance the taxpayer and tax authority relationship, ensuring rights like personal contact with the tax official, the right to make mistakes, and some privacy protections. Secondly, the investigation periods that were prolonged in 2022 will again be reduced to 3 years for standard tax returns and 4 years for complex and semi-complex returns, such as for companies that are required to file transfer pricing documentation. So, and these periods can be extended then with 4 more years in case of fraud. Combating fraud is also a priority of the new government, with 300 new hires that are planned, including hires at the Special Tax Inspectorate. And also, this goes together with some investments in technology tools and further data mining tools, with focus on data from abroad and also including crypto assets. Now, whether this strengthened and added capacity will be dedicated exclusively to fraud prevention, or whether it will have a broader scope in tax enforcement and compliance enforcement, that will, of course, remains to be seen. Then next to that, there's also the penalty policy will be reformed, meaning, like, for instance, there will no longer be an automatic 10% penalty for a first-time infringement in good faith. Also, additionally, the recently introduced penalty payments in case of lack of cooperation, that will also be reformed again. So there are a number of measures in the area of penalty policy that will be taken. And then last but not least, the tax mediation system will be evaluated and potentially be reformed towards a tax arbitration system. Now, it's positive to have additional dispute resolution mechanisms that can efficiently resolve disputes, but I hope that the existing mediation system that is quite well working will not entirely be abolished. But so this will all be to be seen based on the texts of the proposed legislation. So that was it. That were the most important highlights from a procedural point of view.
Well, thank you very much, Veronique, for sharing that. And I think that brings us gradually towards the end of this podcast. Now, a few times, Bart, we had to say, well, we cannot go into the depth. Much more information will have to come. What are now actually the next steps in view of this tax reform, and where can the audience find more information on this?
No, that's true, Peter. So we will, of course, follow up. One of the next steps is, of course, that the government is putting to place, and then, of course, the more work with respect to the draft bills and legislation, making new legislation will start. Expected is that, of course, in the course of this year, 2025, a lot of draft bills will be issued, and probably aiming to get a lot of it into force, perhaps at the end of 2025, but certainly also in 2026. On the other hand, we already know from a budget perspective that some, I would say, more tax cuts or advantages will more from a budgetary perspective be more coming to play by the end of the new government, so more rather to 2029. That's by then, for instance, that also the promise that has been made that the net income of people would increase about with 500 net euros would be at full force. So there also we need to take into account that not everything will be fully operational as from the first day the draft bills would be issued, and of course still need to be enacted and adopted. Of course, from our perspective, and we will follow up further on this also the coming weeks. So new flashes in depth on certain elements will be issued. We will also have, of course, a webinar that will follow, but also again, if there's more news to come, also once new draft bills are issued, we'll perhaps also again record a new podcast, I would say, Peter.
Well, thank you very much, Bart, for that. And with that, I would like to thank the speakers here in the podcast, but also the audience, of course, for tuning in. Stay tuned at the TaxBite podcast. Thank you.